I came across this blog post from 5 years ago on a wealthofcommonsense.com where the author, Ben Carlson, had dug up an old interview from Peter Lynch, that famed stock investor from Fidelity Magellan Fund in the 1990s. And this was on Frontline in the mid-90s. Here is what Peter Lynch had to say about market losses. If you're in the market, you know there are going to be declines. And they're going to happen. And every couple of years, you're going to get a 10% correction. That's a euphemism for losing a lot of money rapidly. Now, that's a correction. A bear market is a 20, 25, 30% decline in the markets. They're going to happen. Welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm your host, and this is the show dedicated to helping you not just survive bear markets, but to rock retirement. We'll be back right after a word from our sponsor. If you want to rock retirement, don't just listen to a podcast or read a book. This is Roger, and I'm here to talk to you about the Rock Retirement Club. This is an interactive community that we've run for over a year where you can interact with people just like you in the same stage of life, some a little bit ahead of you that you can learn from, some a little bit behind that you can teach, where you can get education and tools to help you make better retirement decisions, and where you can go deeper with me, my team, and all the members on topics that we cover on the show in our monthly live meetups, where we get to go deep on a lot of this stuff. If you're ready to rock retirement, I hope you'll check it out at rockretirementclub.com.
Huh? What does that mean?
So today we're talking about bear markets and retirement. So we better define our terms, and what are we talking about when we talk about a bear market? Well, bear market is a condition or a period of time when securities fall 20% or more from their recent highs. And usually there's a lot of pessimism and negative investor sentiment around it. So when we say when securities drop 20% or more, well, that can be any securities, right? There are bear markets in different kinds of markets. We have the stock market, which is usually what we're talking about. Stocks can go down by 20%. There can be a bear market in a certain sector of the stock market. Right now, if you looked at oil and gas markets in the companies that manage businesses in that sector, there's a secular bear market in that particular sector of the stock market. You can have bond bear markets, you can have real estate bear markets, and so on. Now, there are two different types of bear markets that we usually talk about. There's something called a cyclical bear market. This is the more common one where you have short-term downturns of 20% or more. Usually it lasts, within 2 years. And then you have something called secular bear markets. These are long-term time frames where you have below average returns, usually over a decade or more. So a good way to think about that is a cyclical bear market, or a little bit like the seasons, right? They come and go. And then a secular bear market would be a long drought. But that's what we're talking about when we're talking about bear markets. So now that we have that baseline, let's go into the main segment and talk about the history of bear markets and a little bit about how it's really important to be aware and manage them when you're investing for retirement. Bear markets and investing for retirement. That's what we're going to talk about on this series number 2 of investing in retirement with bad markets. So let's look at the history of bear markets. And for bear markets, for this discussion, we're just going to talk about the stock market. The S&P 500 index is what we're going to refer to. Remember, you can't invest in indexes directly, and obviously past performance has no indication of any future results. All right, so there have been 12 bear markets since 1945. The average length of a bear market has been about 14 months, and the average drop from the top of the market to the bottom, 33%. So that's the average bear market experience since 1945. But let's look at equity bear markets, and let's look at a couple of the biggies. So we had the 1929 bear market that lasted 34 months, started the Great Depression. Markets didn't recover to their peak until 1954. That lasted 34 months, peak to bottom. Get this, saw an 86% loss in value. Bam! That's the mother of all bear markets right there. Let's look at the 73 stock bear market. That lasted 21 months. We saw a 48% decline in the S&P 500. That was pretty brutal. You had the Arab embargo, you had Watergate, high inflation, all that stuff, right? Lengthy recession. Let's look at the most recent one, the one that you and I have probably still have scars from, the 2008 market meltdown. That lasted 17 months, from October of 2007 to March 9th of 2009, my son's birthday. I should have known. That was triggered by the housing bubble and the credit burst, right? That lasted 17 months. Peak to bottom, S&P 500, 56.4% decline. These are the kinds of markets that we're talking about when we talk about bear markets. Bear markets are different too, because sometimes everything is going down at once, and sometimes it's only certain parts of the markets, even in stocks. So if we look at the dot-com bubble burst, we had U.S. stocks go down significantly, as we talked about, but you had global commodities up 6%. You had global REITs up 7%. U.S. aggregate bond index up almost 30%. This is from March of 2000 to October of 2002. So you had places to hide if you were diversified. But when we look at the 2008 market meltdown, there were a lot less opportunities to hide from everything that was going on. We had global real estate investment trusts down 71%. Obviously, we know U.S. stocks peak to trough down over 50. Commodities down 40%. Global high yield down 29%. Really, the only place to hide was cash, a la U.S. Treasuries, which were up 4%, and the U.S. aggregate bond index, which was up 7%. Pretty much everything was being thrown out except for very few things. So different markets act differently from a bear market perspective. Sometimes if you're diversified, you're getting a benefit of that diversification effect. Sometimes you're not. So what does this mean for you in retirement? Because that's really the central question that we're trying to build here over this month. And today we're just talking about bear markets. So for this discussion, let's just focus on the 4% rule. The 4% rule is talked about all the time as a retirement strategy. There's been some great studies as to whether that's sustainable income or not. So let's just focus on the 4% rule. And the nice thing about the 4% rule is that it works really well in a spreadsheet. Maybe that's why people like it so much. It's very scientific. So first, let's look at a bear market using the 4% rule. We're going to start off with worst case, which is stocks only. The S&P 500 we'll focus on here, which use historical data. Now, let's assume you started with $1 million and you're going to take out $40,000 a year, and that's factored into your planning, and you happen to be 100% in stocks. And we'll talk about why that seems silly that you'd be 100% stocks. But if I recall, and I don't have the quote, the attribute, but if I recall, Peter Lynch in the day was advocating, hey, you can just invest 100% in stocks, take the income and peel off X amount a year and you'll never run out of money. Remember, that was back before the dot-com bubble burst. So it seems silly now, but it wasn't always silly. So we have $1 million. We're taking $40,000 a year, and bam, we enter a sequence of return where we're entering the Great Depression type of market. So at the end of 1929, the S&P 500 was down 8.41%. We took out our 40,000. So our $1 million went to 879,000 roughly. I'll share these charts in the Rock Retirement Club. Okay, that hurt. We enter 1930. And by the end of 1930, The S&P 500 index was down 24.9%. We still took out our $40,000 because we got to live. Now our $1 million is worth $630,000. Now our 4% withdrawal rate went to a 6.35% withdrawal rate. Whew, not sustainable. Now we enter 1931. S&P 500 down 43.35%. The biggie, we take out our $40,000. At the end of the year, we have $334,000 left. Now our withdrawal rate's almost 12% a year if we maintain this. We lost 2/3 of our assets. I'm going to go two more because it's interesting here. Then next year, 1932, we lose 8.2%, take out our $40,000. Now our $1 million is worth $270,000. The reason I want to go here is because the next year, 1933, we actually have a year where we're up almost 54%. We take out our $40,000 and we recover to $354,000 after the assets went up by 50%. That's the danger, because now, even if the market's recovered from here, which they didn't, you've sold so much that you're never going to recover from that. So the first argument would be, well, Roger, nobody's going to take 4% of the million year after year. We're going to use a dynamic approach where we take 4% of whatever the value is every year. That way we don't get into the situation that you're talking about. That's fair enough. Fair enough. So let's look at that. Let's look at the same scenario, same period of time. $1 million, 4% dynamic. First year we take out at the end of the first year. Let's assume we do this at the end of the first year. End of 1929, we take out our income for the next year is going to be $35,000 because we lost 8.4% in the value of the money. Now, rather than getting $40,000, we're going to take out $35,000. By the end of 1930, when the market was down almost 25%, our income is going to go down for the next year to $25,000 because the value of our assets have gone down. By the end of 1931, when the market was down 43%, we're going to be taking out $13,000 rather than the $40,000 because we're doing this in a dynamic way. So that means year one, we get a pay decrease of 12%. Year two, we get a total decrease of almost 37%. Year three, our income goes down by almost 66%. It helps the math on sustainability, but it sure doesn't help your life. And remember, last week we talked about the central thing we're trying to solve for in retirement is having consistent cash flows to fund the kind of life that we want. And I think even a dynamic 4% withdrawal is not going to give us the consistency of income that we want, even if it makes the sustainability work. Sustaining an ever decreasing life that we didn't want to sign up for is not really a strategy. So the dynamic withdrawal rate is problematic, I think, especially if you're stock only. You say, Roger, but we're not going to be stock only. Come on, don't be silly. We're going to have, let's say, a balanced portfolio, a 60% stock, 40% bond portfolio. Fair enough. That will give us more sustainability, most likely. So let's apply the same numbers to the Great Depression. Year one return for the year ending 1929, a 60-40 allocation would have gone down by 2.42%. Heck of a lot better. We take out our $40,000. Now we're going to have $936,744. 4% withdrawal went to a 4.25% withdrawal. Year two, end of 1930. A 60-40 allocation would have gone down by about 13.4%. We take out our $40,000. Now our million went to $776,000. Just went over a 5.5% withdrawal rate. Year three, end of 1931, we take out our $40,000. Markets were down 28.5% for a 60-40 portfolio. Our million is worth $526,318. Now we're at a 7.6% withdrawal rate. It helps, but the math still gets a lot more problematic if we're dealt an iteration or a sequence of return like we're talking about. Again, we're looking at probably the worst case scenario right here. Let's apply that to the dynamic 4% withdrawal ratio, just so we can look at that one as well with a 60-40 allocation. And I'll cut to the chase here. Year one, our income would go down by 6% to $37,000. Year two, our income would go down a total of 22% to $31,000 from the beginning, 40. Year three, that big down year, 1931, our income would have gone down to $21,000, which is almost a 47 or a little over a 47% drop in income. 60-40 allocation, taking a dynamic 4%, still doesn't give us any consistency in planning a life by being able to pay for it. This is the impact that bear markets can have. And in this instance, in the 60-40 split with stocks and bonds, this is when we're diversified in U.S. stocks and the bond index in this case, right? Or something similar to the bond index. So diversification helps a lot. But if we're thinking of this 4% withdrawal rule, it doesn't get us all the way there. Now, I did this for the .com as well, but for time's sake, we'll review that when we're having our meetups. So, but what are the lessons learned here when we're talking about bear markets? Number one is bear markets can have a huge impact on our retirement income, even if we're diversified. Bear markets can happen in lots of different markets, and having diversification doesn't get us all the way there to the goal of, I've built up these assets, I'm ready to retire, and I have to put a strategy in place to maintain my income, but also, we're talking on the short term, maintain my income regardless of the sequence of returns. What we didn't even address in this scenario is maintaining my income inflation adjusted over my 20, 30-year horizon that I'm planning for. Bear markets can have a huge impact. So we need to do more than just simply think of a 4% withdrawal rule when we're planning for this, because there's a lot more that needs to be done. This is probably, from a market perspective, the biggest risk we have. Next week, we're going to talk about crashes, market crashes. That is probably not near as significant as bear markets, where we're having this drawn out period of time when we're taking money from our assets and we're having our asset values go down year after year. So we have to be able to deal with this, and that's what we're going to build throughout this month. But I wanted to review bear markets and also talk a little bit about the 4% withdrawal rule. And while it may make sense in a mathematical formula, a little problematic to try to implement, especially if you start to overlay psychological and emotional impacts of these types of markets as well. So with that, let's get on to our question and answer session with our awesome Nicole Mills. With that nice, cool, jazzy music, we're bringing on Nicole Mills to answer some of your questions. Now, Nicole, before we get started, hello.
Hello.
And before we get started with the questions, how can people leave a question so we can answer them? Because we're getting back to basics here, right? We're going to answer questions every week.
That's right. You're the retirement answer man, so we need some questions to answer. They can go to rogerwhitney.com/Ask Roger.
And if we answer your question on the show, or try to email you so you know that it's coming up. And we really love audio questions. Before we get started here, Nicole, I have a problem.
What is your problem?
So last week we were talking about our words for 2020.
Mm-hmm.
Unity is just not really sitting with me.
You don't like it.
It just doesn't move me.
Okay.
And I was trying to come up with one that did, because usually they just sort of strike me and I'm like, yes, this must be the word for the year. And so I'm back to pause or basics. I think I want to go with pause.
Pause.
I'm making an adjustment to my word for the year officially.
What does pause mean for you?
It's around the lines of what I wanted with Unity is I want to pause before I make commitments, whether that's commitments for a new client, a new project, commitments that require money or require my or my team's time, our time. I want to pause. And that pause will give me a chance to filter through the people I trust most, you, Tracy, and the team, and also myself to reflect and not just be so knee-jerky on things. Because I'm so action-oriented. So I just need to pause.
I like that.
Okay. So I'm adjusting. It means more to me.
Well, it's your word, so you should definitely pick something that means something to you.
Well, I appreciate that. So do we have any questions? Does everybody have this retirement thing figured out?
I think everyone's got it figured out, and we should just go home, take a nap.
Okay, let's do that.
Actually, we've got a question from Kathy, and it's an audio question.
Hi, Roger. My question is about when to dial back risk. I am 51 years old, and I know that I have enough assets accumulated for my entire retirement. But I'm wondering, when do I get to the point where I can shift down, out of equities and just really bring the risk down? Is that kind of a personal decision? Thanks so much.
Wow. Well, good for you, Kathy. 51, and she knows she has enough.
That's awesome.
Yeah, that's very unusual. So let's think about this, Kathy. So first off, let's talk about you have enough. That's a very firm statement. Better trust your model and your process that led you to that decision, and make sure that there's not an error in that you're unaware of. Just a thought. You're 51, so we're talking about a 40 to 50 year timeline that you're planning for. You didn't mention how long until you retire, but I'm going to take as truth that you have enough. So you have two main risks, and I want to make sure you're factoring. Before I get to how to frame how you think about this, just make sure we know you have two main risks that you're dealing with here. You have near-term volatility. Well, you have volatility always, but that's the one that we think about. Bear markets we just talked about. But you also have a long-term risk of inflation and a long-term risk of shocks, whether it's an inflation shock or some other sort. So make sure you're counting both of those in. Wow, Nicole, I guess if you know you have enough, it almost becomes a question of stewardship, being a good steward of it, right?
Right.
I've had clients where they were so adverse to any kind of short-term volatility and they knew they had enough that if they just stayed in cash, that they wouldn't spend it all. And they chose to do that. I think that's an acceptable strategy if you know, don't you?
I think it is. Without knowing Kathy, obviously, I think sometimes when you are the kind of person that's a saver and you've had enough, that can lead to fear of spending out a little bit.
That's true. And I think of it's burying it in the sand so you don't lose it, which is a good strategy to a point. A lot of times we think of these decisions as extremes. I have enough, so should I take any risk or take risk? Well, there's lots of different levels of risk. And there's also a question of, you say you have enough, and then you have to go back to enough for what? Is it you have way more than enough because you haven't leaned into what you could create as a life? Sometimes I'll tell you one thing I've noticed, Nicole, and I'm sure you've seen it in the clients we deal with. The people that end up being in a position where they have more than enough struggle with being creative and leaning into how to use it to express a life.
Right.
So I would challenge you a little bit on that, Kathy. But let's just talk about the investment risk decision. Good steps to go through are determine the minimum effective dose of risk that you need to take to create the kind of life that you've modeled. I think that's always a great, healthy first step, and I'm assuming that you've done that. If you don't need to take any risk, it's pretty important that you know that. And then you can intentionally choose to take incremental risk, and we're defining risk as volatility with stocks and so forth. Above that, very few people take that minimum effective dose, but it's important to know what it is so you can ratchet up rather than thinking you have to take risk. So one thing that you could do there, if you've determined this, is how much do you need to secure your life in the way that you've defined it? Again, assuming you have a good model and process. And then isolating the excess, the cream at the top, and managing that different than the base that you need. And Good to Great, they talk about marching above the death line in a company. You don't want to make decisions that destroy the company. Well, what's marching above the death line for you? Whatever excess is there, maybe that's your risk budget, and you use other vehicles that are safe to protect this base life that you've defined. I think that's not a bad strategy. A lot of this does come down to personal preference in terms of evaluating your psychological makeup and emotional makeup. Some people can't handle not being in the party, getting FOMO, fear of missing out. Thank you. Fear of missing out. Some people fear of missing out, and they're going to have to take investment risk because they would go mad seeing everybody having fun and making money when they're not. Some people value protecting their assets. That's much more important to them than any kind of return. So you're going to have to make your own personal decision along that lines. But I would think about, are you thinking big enough about your life? Can you establish a risk budget? When should you do this? Is there a timing aspect here? Well, if you already know you have enough, now's the time to start doing that. You're exiting the accumulation stage need, and now you're focusing on how do you secure this, and then everything else can just be gravy. Hopefully that'll help your thinking a little bit.
We have another audio question from Hal.
All right, Hal, let's hear you.
Question I have for you today is, should I convert our traditional IRAs to Roth IRAs, or should we pay off our mortgage? We want to max out our tax bracket while tax brackets are low with paying off the mortgage or doing Roth conversions. Though also we want to keep an eye on not busting the adjusted gross income cap for Medicare premium calculations in future years. Some background, I'm 64 and not working. We'll take Social Security at 70. My wife is 55. She's working half-time and we'll take Social Security at 67. Since the source of the dollar pay off the mortgage for the conversion to the Roth or paying off the mortgage will come from a traditional IRA or 401k. The mortgage is $200,000, 3.875%. We file jointly and are in the 22% marginal tax bracket. I have a pension and don't ever plan to ever have to have access to or use a 200k for future living expenses. Roths are 20% of the portfolio. Tax-deferred assets are currently 70% of the portfolio. Just wondering what your thoughts are. Thanks.
Thanks for the question, Hal. And I noticed that you actually emailed that in as a question. Then you saw that we had a recording feature, so you recorded it too, which I really appreciate. I always have to start off as you never have enough information to know, right? There's a lot of information gaps here. But let's think through this. Ultimately, your wife, who is 9 years younger, can stretch over her life, whether it's an IRA, when we're coming to required minimum distributions. Now you have 8 years until you're going to do required minimum distributions. Roth conversions. Do you take money out? I see 3 basic options, right? Leave money in there and then just let it grow and then have your RMDs when you need it and then stretch to your wife. 2, take the money out to pay off the mortgage. So $200,000 is going to run you up the tax bracket. So you're going to take out a lot more than $200,000 to pay the tax to pay off the mortgage. Or 3, start to do Roth conversions and keep the mortgage. Now you said that you, and I'm assuming you mean you and your wife, have enough. Right now, you don't need this money for your lifestyle. And does that mean your pension is joint life? So if there's already enough money or income there for you and your wife, and you don't really need this money, then it's just really optimization. So I think consider doing, whether it's conversions or taking money out strategically from your pre-tax dollars, at least up to the top of the 12% tax bracket, which if you factor in the standard deduction is right around $100,000. Make sure you're getting up to the top of the 12% bracket. And even if you're just taking the money out and throwing it toward your mortgage or doing something with it after tax or converting it to a Roth, I think that makes total sense to me because it goes from 12 to 22% above that top line of the bracket. So that's going to help you out and just from a strategic standpoint. So if you do that, do you convert to Roth or do you pay off the mortgage? You didn't state whether you were going to pay the tax outside of the Roth. That helps doing Roth conversions if you're going to. If you're going to take money out of the IRA and pay the tax penalty from the withdrawal and then convert the rest, that makes it more problematic. Given the facts that you gave me, I'm a fan of just making sure you fill up the tax bracket, at least to the top of the 12% tax bracket, and doing the Roth conversions rather than paying off the mortgage. And my logic is that it sounds like you have enough income sources from pension and then when Social Security starts to cover the mortgage. And that will help set your wife up a lot better, assuming that she's going to outlive you given her age and the fact that she's a lady. Nicole, it's always hard to answer these questions with the facts that you're given, and you can never get enough facts set in these.
I feel like we should put the disclaimer in the middle this time instead of at the end.
I always have more questions, right? And that's the hard part with these type of things. But I think the way to think about it, Hal, is assuming that you and your wife have enough income without this IRA asset or 401k asset. Now we're optimization. I would at least fill up the 12% bracket to do Roth conversions. And then if you have enough sustainable income, I wouldn't be too worried about the mortgage.
All righty. Our last question is from Bill. He wrote in, we have no kids, close relatives, or close friends to look after us in the future. My concern is as we grow older, neither one of us recognizes that we have issues. I've done some research on aging life care associations and aging life care managers but I don't know if this is the right solution or not. Your thoughts?
Wow. I'm glad he asked for thoughts and not answers, Nicole.
That's a tough one.
That's a tough one. Now, next month in February, we're going to be covering long-term care and how do we manage that risk. So that's an important topic, and it's been coming for a while, and it sort of weaves into what you're talking about here. When I was visiting a friend recently, Nicole, I don't know if I shared this with you. He volunteers at an aging facility, a long-term care facility. It's one of those facilities I think that you're talking about, Bill, where you have a building where people are pretty much independent, and then they can progress all the way through to some assisted living, all the way to, full-on care for dementia and Alzheimer's. And absent having a family network, I think those are things that we really need to look at. It was very, very sobering, Nicole, to be in one of those centers.
My grandfather was in memory care for about 6 months last year. So,
especially when you get to the true on full-time care, people walking around with bicycle helmets on because they run into things, people figuring out how to do coloring books, people literally unable to communicate or move that were alive. And I think evaluating these types of things and finding one that you can, at some point, doesn't mean now, Bill, at some point you can start and have independent living, but you have a framework in place to dial up the care if it's ever needed. I think that is a very wise thing to do. I'm early in my exploration of this. We're going to start with long-term care insurance of how to pay for some of this stuff. That's what we're doing next month. But I think we're going to dive into this stuff in the future even more because whether you have family or not, Bill, I think it's a really important issue that at some point we need to think about. Lucky for me, I have 2 kids and Nicole to take care of me.
I will definitely let you know when you have issues.
You always do. Well, with that, Nicole, I think we should go set a SMART sprint.
Let's go for it.
On your marks, get set.
And we're off to set a little baby step we can take in the next 7 days to rock 2020 in retirement. In the next 7 days, I want you to do something I think is actually pretty crucial. And it goes along with the theme of this month. And this is a great time of year to do this because you're going to be getting all of your investment statements, your year-end investment statements. I want you to understand the investment risk that you're taking. So I want you to gather those statements. You're going to need to do it for tax reasons and updating your net worth statement and things like that. And I want you to get a target of what your asset allocation is. How much do you have in stocks? How much do you have in bonds? How much do you have in cash? Include your cash reserve accounts. So you can have an understanding of, okay, man, if a bear market happens this year, this is how I'm allocated. And then there are plenty of places where you can find, how those kind of portfolios would have done in a downturn. A good tool, and I use it all the time, even in my practice, is if you go to morningstar.com, they have an instant X-ray tool where you can enter the symbols of things and it will give you the aggregate allocation of the symbols and the values. But I think this is critical, especially if you're on that runway within 5 years of retirement or slowing down or leaving your full-time job. This is the time not to be too far over your skis, as they say.
Now it's time for the all-important disclaimer. Bum, bum, bum.
Thank you, Archer. Yep, we have to have that all-important disclaimer, and that is before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor. And remember, you cannot invest in indexes. They're models only, and past performance does not guarantee future results. Hey, Nicole, I think he's a star.
Oh, yes. You missed the little cannonball roll he did as he was exiting the room.
Thank you, Archer, for lightening up our all-important disclaimer. And thank you for listening to the show. We're excited to be on this journey with you in 2020.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.